Negative gearing is one of the most talked about and most misunderstood concepts in Australian property investing. Some people describe it as a powerful tax strategy, while others see it as risky or only useful for higher income investors. In this video, we'll explain negative gearing in simple terms, without jargon, so you can understand what it actually means and whether it may suit your situation. Let's start with the basics. Negative gearing occurs when the costs of owning an investment property are higher than the income it generates. In simple terms, the property runs at a loss each year. The rent you receive does not fully cover expenses such as loan interest, council rates, insurance, maintenance, and property management fees. So why would anyone choose a strategy that involves losing money? The main reason is tax treatment. In Australia, if an investment property produces a loss, that loss can often be used to reduce your taxable income from other sources, such as wages or salary. This can lower the amount of tax you pay. Here's a simple example. Imagine you earn $90,000 a year from your job, and your investment property runs at a $10,000 loss over the year. That loss may be deducted from your taxable income, meaning you are taxed as if you earned $80,000 instead of $90,000. The tax saving reduces the impact of the loss, but it does not remove it entirely. This is where many people get confused. Negative gearing does not mean the government is covering your losses. You are still funding the shortfall yourself. The tax benefit simply reduces how much that loss costs you. If you're enjoying this, hit like to help more people find this video. So why do investors still use negative gearing? Most do it because they are aiming for long-term capital growth. The idea is that while the property may lose money in the short term, its value could increase over time. If price growth is strong enough, the long-term gain may outweigh the ongoing losses. This approach tends to work best in markets with strong demand, limited housing supply, and stable employment. Historically, cities like Sydney and Melbourne have attracted negatively geared investors because of their long-term growth potential, even though rental yields are often lower. However, negative gearing is not without risk. One major risk is interest rates. When rates rise, loan repayments increase, which can quickly expand annual losses. A property that is only slightly negatively geared can become a financial strain if rates move higher. Another risk is relying too heavily on future price growth. Property values do not rise in a straight line. Markets can stagnate or fall for periods of time. If growth is slower than expected, investors may end up carrying losses for longer than planned. It's also important to understand that negative gearing works differently depending on income level. Higher income earners usually benefit more because they sit in higher tax brackets. For lower income earners, the tax benefit is smaller, which can reduce the effectiveness of the strategy. Now, compare that with positive gearing. A positively geared property generates more rental income than expenses, meaning it produces surplus cash flow. While these properties may not always deliver rapid growth, they reduce financial stress and provide greater stability, especially during uncertain market conditions. In 2026, many investors are more cautious. Higher interest rates and cost of living pressures mean fewer people are comfortable running large ongoing losses. As a result, cash flow, rental demand, and financial buffers are receiving much more attention. So, is negative gearing good or bad? The honest answer is that it depends. It can work as part of a long-term strategy for people with stable incomes, strong buffers, and a clear understanding of risks. It is not a shortcut to wealth, and it is not suitable for everyone. If you are considering negative gearing, there are a few key questions to ask yourself. Can you comfortably afford the loss if interest rates rise further? Are you relying on capital growth to justify the numbers? And do you have enough buffer to manage vacancies, repairs, or changes in your personal circumstances? Before making any decisions, it's sensible to speak with a qualified accountant or financial advisor. Tax rules can change and individual circumstances matter. What works well for one investor may not work for another. To sum it up, negative gearing is a strategy where investors accept short-term losses in exchange for potential long-term growth and tax benefits. When used carefully, it can play a role in a broader investment plan, but it requires discipline, planning, and a realistic view of risk. Understanding how negative gearing actually works puts you in a much stronger position than following headlines or assumptions. Property investing rewards informed decisions, not shortcuts. If you found this helpful, subscribe for more property insights.